A tech-driven money printer just got turned on in the dark, and stocks are mooning because of it. The Federal Reserve just kicked off what people are calling an economic reset, while cutting rates without the usual inflation or jobs data. Meanwhile, Japan is flirting with a full-blown economic crisis that could slam into the US market like a delayed tsunami. If you think this is just another boring Fed update, this might be the moment your portfolio either levels up or gets completely wiped out. Welcome back to the comment section with Thomas Paul, where we stare into the financial abyss together and try to profit from it. Today we're breaking down why the Fed just cut rates again, why this time is totally different, why stocks are ripping higher, and why that should make you a little bit nervous instead of just high-fiving your brokerage app. Let's start with what actually happened. The Federal Reserve just cut interest rates for the third time this year. That alone? Not shocking. We've seen rate cut cycles before. But here's where it gets weird. This time they did it while basically flying blind. Normally, before they make a big move like this, the Fed has fresh inflation numbers, fresh jobs data, and a whole army of economists telling them, here's exactly how screwed we are. But because of the government shutdown, key data, like the October jobs report, was delayed or outright canceled. That means the Fed lowered rates without seeing the latest numbers on inflation and employment. So yes, the people who control the price of money for the entire US economy just hit the easier money button with missing data, because that's never gone wrong before. And here's where things get interesting. At the exact same time, they're hinting at more easing, more liquidity, and potentially more money printing to keep markets stable. This is why some analysts are calling it the start of an economic reset. Not because the economy suddenly collapsed overnight, but because the rules of the game are changing. Again, we're shifting from a higher for longer interest rate environment, where everything is supposed to be tight and disciplined, back toward, let's not crash the market please, where stocks get a nice sugar high from cheaper money. And sure enough, markets reacted exactly how you'd expect spoiled children to react to free candy. Stocks ripped higher. But wait, this is not just a happy Wall Street party. While the Fed is cutting rates with incomplete data, Japan is quietly sitting on an economic powder keg that could spill over into global markets, including the US. And we're going to get there. But first, let's pin down what the Fed actually did and why investors are suddenly calling this a potential wealth transfer moment. So, what are the key takeaways from this move? First takeaway, the Fed is prioritizing market stability over pristine data. They didn't have the full October jobs report. They didn't have their usual neat little Excel sheets of what inflation did last month, but they went ahead and cut rates anyway. That tells you something huge about their mindset. They are more worried about keeping the system moving, credit flowing, markets calm, sentiment positive, than they are about waiting for perfectly accurate numbers. Translation, they are acting preemptively. You don't do that unless you're nervous about something breaking. Second takeaway, this is not normal easing. It's easing into uncertainty. Usually, by the time the Fed cuts rates a few times, everybody agrees the economy is slowing, unemployment is ticking up, and inflation is calming down. That's the classic textbook cycle. This time, the narrative is messier. Inflation has come down from the extremes, but is still a concern. We're not in a full recession, but there are obvious cracks. Credit stress, weaker sectors, slowing growth in some areas. Instead of reacting to clear, undeniable pain, the Fed is cutting into a messy, partially visible situation. That's why people are saying we're at the beginning of a reset. It's not, we broke the system, now we're fixing it. It's more like, the system looks fragile, let's pump in some cushion before anyone panics. Third takeaway, stocks are loving this, for now. Equity markets did what they always do when the Fed says, money's cheaper now. They jumped. Growth stocks, rate-sensitive sectors, anything that benefits from cheap borrowing, boom, green candles. Because nothing says stable long-term economy like investors piling into risk assets because debt got slightly cheaper again. But here's where it gets even wilder. The same easy money environment that pushes stocks higher also tends to push people into more speculative behavior. You get meme-like rallies, FOMO buying, and people convincing themselves this time it's different. Meanwhile, the underlying issues, like government debt, structural deficits, and global imbalances, are still very much there, quietly doing push-ups in the background. Fourth takeaway: Japan is the wild card almost nobody wants to think about, but should. While the Fed is easing, Japan is dealing with a potential economic catastrophe. They've spent years with ultra-low or even negative interest rates, printing money like it's a competitive sport, and supporting their bond market with massive intervention. Their government debt is enormous. Demographic trends are brutal, and the pressure on their currency and bond yields is intensifying. Why does that matter to you, sitting there with your US brokerage app and your index funds? Because Japan's problems don't stay in Japan. If their economy stumbles hard, big Japanese institutions might have to sell assets globally, US stocks, US bonds, foreign investments, to cover losses or defend their currency. That selling pressure could slam into the same US markets that are currently partying on Fed rate cuts. So on one side, you have the Fed, basically saying, "We'll keep things easy, don't worry, we've got your back." On the other side, you have Japan, potentially forced to do the exact opposite: tighten, defend, liquidate. That tension? That's where opportunity and risk both live. Now let's zoom in on how this reset could actually play out and why people are calling it either the greatest wealth transfer of our generation or the setup for a painful wake-up call. Here's the basic idea behind the wealth transfer reference. When the Fed eases aggressively, especially when markets are already nervous, you create a line between people who understand what's happening and can position for it, and people who just chase whatever's going up on their screen. If this reset leads to years of elevated asset prices, people who own quality assets, stocks, real estate, businesses, could see huge benefit. If it leads to a bubble that bursts, then those who FOMO into garbage at the top get wrecked, and those sitting on cash, hedges, and solid fundamentals scoop up assets at a discount. It's not conspiracy. It's just how monetary cycles work. Someone's panic is someone else's opportunity. And here's where things get really important for you as an investor. What are the implications of this Fed reset for your portfolio? What should you actually be watching beyond stonks go up? Let's break this down. First, think about interest rates like gravity for financial markets. When rates fall, gravity gets weaker. Stocks can fly higher because future earnings are more valuable when discounted at a lower rate. Companies can borrow more cheaply to grow. Consumers refinance, spend, and take on more debt. Risk assets feel lighter, easier to justify. That's what we're seeing now. Gravity is being dialed down, even though the Fed doesn't have a full picture of the terrain. But lower gravity also means more stuff floats that probably shouldn't. Zombie companies that survive only because debt is cheap. Over-leveraged players who roll over loans instead of fixing their balance sheets. Speculative manias that thrive on "money is free again, bro." So, as an investor, your first big implication is this: don't confuse a liquidity rally with a healthy economy. Stocks can go up for a long time even if the underlying situation is fragile. In fact, that's kind of the point. The Fed is trying to cushion the system so it doesn't break. Your job is to ride that wave intelligently, not pretend the ocean disappeared. Second implication: bonds and yields are now a crucial tell. If the Fed is in easing mode while inflation hasn't fully died, bond markets become the referee. If long-term yields start dropping, it suggests the market believes growth is slowing, and the Fed might have to cut even more or keep things easy for longer. If long-term yields spike, it suggests investors are worried about inflation getting reignited or government debt spiraling. So one thing to watch like a hawk: the yield on longer-term U.S. Treasuries. That's the market's way of voting on whether this reset is controlled or nonsense. Third implication: the Japan connection. Japan has been the test lab for extreme monetary policy for decades. Ultra-low rates, massive money printing, near constant support for government bonds. They've stretched the "how far can you go" question longer than almost anyone else. But if their economy really does hit a breaking point, if their currency slides too far, if yields spike, if confidence erodes, they may have to reverse some of that easy money. That can trigger selling of foreign assets, including U.S. stocks and bonds, to stabilize their own system. For you, that doesn't mean sell everything now and go live in a cave. It means understand that a shock from abroad can hit U.S. markets even when domestic news looks fine on the surface. So if you wake up one morning and see headlines like "Japanese markets plunge" and "Yen crisis," that's not just Asia's problem. That's your portfolio's problem. But wait, it gets even wilder. If Japan's issues spill over and create global volatility, what does the Fed usually do? You guessed it. More easing, more liquidity, more support. That's how you get these weird, self-reinforcing cycles where the very same over-leveraged system that causes the crash becomes the excuse for even more intervention, which pumps asset prices again until the next bigger problem. So, what can a rational investor actually do with this chaos? First thing, decide what game you're playing. If you're a trader, you care about short to medium-term moves. Fed cuts, sentiment shifts, liquidity waves, these are your playground. You're watching how rate-sensitive sectors react, how tech behaves, how small caps respond to easier credit. You're not pretending you're Warren Buffett, you're surfing policy. If you're a long-term investor, your view is different. You care less about what stocks did this week and more about, are we in an era of structurally lower growth with periodic stimulus? Because if we are, then owning long-term productive assets, profitable businesses, real estate with solid cash flow, diversified exposure, continues to make sense, as long as you can stomach volatility. Second thing, watch your leverage. When interest rates fall, borrowing feels tempting. Margin feels safer. Real estate investors start saying dangerous phrases like, "The bank is basically giving me free money." Remember, lower rates can reverse. Liquidity can disappear. If this reset goes wrong, if inflation flares back up, if foreign crises hit, if something breaks in credit markets, the same leverage that boosted returns will turn around and eat you. So, if you want to benefit from easier money, try to do it from a position of strength, not desperation. You want optionality, not dependence. Third thing, focus on quality over hype. In a world where the Fed is cutting with partial visibility and Japan is sitting on a potential crisis, the gap between quality and junk matters more. Quality companies with real cash flows, durable advantages, and manageable debt are positioned to survive turbulence and thrive when money is cheap. Junk companies that rely on constant refinancing just to exist? Those are the ones that can implode when conditions tighten unexpectedly. The wealth transfer idea is really about this. Good assets that survive the chaos get bid up over time. Bad assets eventually get repriced to zero. The transfer happens from people who bought stories to people who bought substance. Fourth thing, have a watch list, not a wish list. A wish list is you saying, "I hope everything pumps forever and my speculative plays become Lambo money." A watch list is you saying, "If this reset leads to a rally, I know what I want to trim. If this reset leads to a shock, I know what I want to buy at a discount." Think in scenarios. If markets keep climbing on Fed cuts, do you have a plan to take profit or rebalance into sturdier names? If we get a Japan-driven shock and stocks drop 20%, do you know which quality companies you'd be thrilled to own cheaper? Because here's the uncomfortable truth. The Fed doesn't know exactly how this plays out. Japan doesn't know how this plays out. Nobody does. You're not supposed to know the script. You're supposed to know how you'll respond, no matter which script we end up in. Now, what should you actually be watching next as this economic reset develops? First, Fed language, not just Fed actions. They've already cut rates 3 times. The next big question is, do they signal they're done for a while, or do they hint at more cuts? If they start talking about data dependence again but still don't have full data because of government disruptions, that's your clue they're basically guessing with slightly better spreadsheets. If they emphasize financial stability, markets, and credit conditions, that's your clue they are laser-focused on preventing a market accident. Second, inflation trends. If inflation continues to drift lower or stay under control, the Fed has cover to keep things easy. If inflation starts to reaccelerate while they're cutting, that's when things get uncomfortable. Because then they're stuck between two bad options: fight inflation and risk crashing markets, or support markets and risk eroding purchasing power. You want to pay attention to the direction, not just the headline number. Third, employment and growth data. Once the shutdown distortions clear, we had a canceled or delayed jobs report. Eventually that pipeline will clear and we'll get a more honest peek under the hood of the economy. If those numbers point to rising unemployment or sharp slowdowns in hiring, that supports the "we needed to cut" narrative. If they show resilience, then it starts looking more like the Fed fired some bullets early. Fourth, Japan's yields and currency. This one sounds niche and boring, but it's not. If Japanese government bond yields start spiking or the yen starts collapsing, that is a huge warning sign. It says, this ultra-easy experiment might be hitting its limits. And global investors will not ignore that. If you see persistent headlines about emergency interventions, bond buying operations, currency defenses, that's your cue that the risk of spillover into global markets is rising. And finally, credit markets. Stock traders love their charts, but credit markets are like the smoke alarm in your house. If corporate bond spreads widen, meaning companies have to pay more to borrow, that signals rising concern about default risk. If commercial real estate loans start defaulting in larger volumes, that's another crack. The Fed can cut all at once, but if credit markets decide certain borrowers are too risky, the pain can spread fast. So to recap this in plain English, the Fed just cut rates again without fully updated data, because they're more scared of something breaking than they are of waiting for perfect information. That marks the start of what people are calling an economic reset, a shift toward easier money and more intervention to keep markets stable. Stocks responded by ripping higher, because of course they did. But this rally is built on cheaper money and faith in the Fed, not some miraculous overnight cure for structural issues. Japan is the global wild card. Their heavily manipulated rates, huge debt, and fragile currency mean that if their system stumbles, it can cause selling across global assets, including U.S. markets, even while the Fed is easing. For investors, this environment is a double-edged sword. It can be an incredible opportunity if you focus on quality, manage your risk, watch leverage, and think in scenarios. Or it can be a disaster if you blindly chase whatever's going up, assume the Fed will bail out everything forever, and ignore global risks. The wealth transfer everyone talks about? It's not some secret meeting in a smoky room. It's just what happens when those who understand the cycle use volatility to accumulate assets, and those who don't use volatility to panic sell at the bottom and FOMO buy at the top. So, what do you do now? You get informed, you stay flexible, and you stop pretending central banks are omniscient gods. They're just people with models, trying not to crash the bus while half the dashboard is flashing error messages. You don't have to predict the future. You just have to avoid the dumbest risks and be ready to act when the smartest opportunities show up. If you want to keep up with this story, the Fed's next moves, how Japan's situation evolves, and what it all means for your money, this is literally what we do on this channel. Now I want to hear from you. Do you think this economic reset is the start of a massive bull run, or the setup for an even bigger crash down the road? Are you buying this rally, sitting in cash, or just aggressively pretending not to look at your portfolio? Drop your hottest, most unfiltered takedown in the comments. I actually read them, even the ones that say I sound like your suspiciously well-informed cousin at Thanksgiving. If you got value out of this breakdown, hit the like button so the algorithm knows you're into this kind of deep dive content, and subscribe to the comment section with Thomas Paul for more sarcastic therapy sessions about money, markets, and the geniuses running them. Thanks for watching. Stay rational, stay curious, and I'll see you in the next episode.